Today, fellow investors, the Fed cut rates, Powell cut rates, that only means one thing: bubble up, because after Powell there will be even more cuts, which leads to this bubble being the last bubble of likely our lifetimes. If we look at the Fed's December plot, let's say the long-term rate stabilizes around 3, another 1-2 cuts coming, and that's about it. However, this stability of the Fed used to be lower just a while ago is something they never hit. If we see here, this is the unemployment rate creeping up a little bit, allowing them to cut rates, but whenever the unemployment rate started creeping up, that was always signal for a recession, which are these gray columns. Apart from AI and government debt, we can say that the economy is already in a recession, and that's why the Fed started cutting. However, on the other hand, Powell also touched on that, they are cutting rates in the most expensive market ever. So we are now at 230% of US GDP, the US stock market, much higher than the dot-com bubble. And what does the Fed do? It cuts rates. That pushes the markets even higher. If we look at the situation, over the last 40 years, rates have been going nothing but down. Short-term experiments of higher rates quickly lead to lower rates because the system simply can't survive. And that's exactly what Powell discusses. On one hand, we have inflation still there. He blames it to tariffs, but it is there, doesn't matter on what. And on the other hand, we have rising unemployment. And then look at interest rates from the Fed and the stock market to GDP. As interest rates go lower, stocks have been going higher. When interest rates are pushed higher for whatever reason, following, there is usually a stock market contraction, a significant one. So that is the name of the game. The fact is that the Fed wants to push stocks higher, wants to push inflation lower, but that is a difficult task, especially because now interest payments of the government are almost 3x what those have been just 10-11 years ago, and you can see here the spike over the last few years as interest rates went up. This is not sustainable. The only solution is rates down, inflation up, because without that you cannot ease this deficit burden. And the next Fed chair will be one that will listen to Trump and cut rates even more. And as Trump says, so somebody who has to be honest with interest rates, honest for him means our rates should be much, much lower. What does that mean? It means that pension funds in bonds will see lower yields again. On one side, they are forcing you to go into riskier and riskier assets. That is also negative for the dollar. You will see a steepening of the yield curve. We already see higher, let's say, relative long-term rates, lower, of course, short-term rates. But the key is that the US government, I think 84% of the borrowing made over the last 12 months is all in 3-month treasuries. So they are on the lower end of that yield, which means that if ever the Fed loses control, those interest payments might go to the moon. Conclusion: bubble, more bubble, and nobody can see where this bubble will finish, if ever. On top of the Fed lowering rates, starting quantitative easing again, printing money, there is also AI adding on top of that. And there was a great memo by Marx. Some see it as a bubble, some see it as not a bubble because it's cheaper, let's say, than the dot-com bubble. And here you have the valuation. The current P ratio of the key players is still, let's say, below the P ratio of the dot-com bubble. Nifty 50 in the 1960s was 50 P ratio, so 50, 40, 30. Who knows whether we'll see a trend there. And he quotes also Sam Altman from OpenAI. It is a bubble, yes, but it is the most important thing to happen in a very long time. So again, yes, we'll see. The thing is that this bubble simply must continue. However, that also means that this could be the very last bubble you see in your lifetime. What am I saying? If you cut rates, you sacrifice the dollar, you let inflation loose, you pile on the debt to keep the imaginary economy growing, push more inflation, AI, bubbles, valuations don't matter because just this talk from the Fed, something that was already known, pushes the market up almost 1% in an hour as the Fed is speaking, which means the nominal growth, the focus of everyone will be there, but the real growth is always questionable. And just look at this. If you look at US GDP growth, let's say around 2% over the last few years, and the bulk of that lately is based on AI spending from the hyperscalers, going up to 500 billion in spending on investing, all good. On top of that, there is always the government deficit that the government is borrowing 1.7 billion per year to spend. That also pushes the economy higher. Without the government's borrowing, without the cuts, real GDP will be zero or negative. We could say the US on real terms, without the borrowing, without the financial engineering, has been in a recession for the last 3 years. And in that situation, the bubble must continue. The government needs to keep on borrowing just to make it look like everything is great. Push stocks higher no matter what, and hope that this wealth effect will trickle down into the economy. Because what is the alternative? Well, the alternative is to stop borrowing, spend less, go into a recession. From these already high levels, you're looking at the Nikkei stock market. What will push stocks up if you don't cut rates and print money? If you, let's say, spend $1 trillion less from federal finances, that is likely, on a conservative note, $1 trillion less of GDP increases, and on 30 trillion, that's 3% down of GDP. That is a recession. So the alternative to pushing this bubble higher is a 4-year recession, the process of purging the bad in the economy, things that are healthy. But after 15 years of no recession, nobody wants to feel the pain. Unemployment at 10%, perhaps, productivity increases, education. Who's mentioning education? Nobody. No social net in the US. So, very, very ugly situation. Therefore, they have to push the Ponzi scheme as long as it can go. The bubble must continue. The government, the Fed, will do whatever it takes for it to continue until it doesn't work. It's impossible to predict. It's impossible to be rational about it. It's impossible to stay solvent betting against it because it's all financial engineering. What one has to do, focus on the portfolio, the value, no matter what happens in the economy. If you can focus on that, that's already great. And we'll discuss it tomorrow, looking at oil stocks, and Sunday, looking at some very interesting portfolios, $8 million portfolios, and then you can see how are you structured compared to that, and especially in line with this market. Subscribe. I'll see you in the next videos.